All right, everyone. Today, we're digging into the GDS Holdings Q2 2025 earnings call. And let me tell you, this was so much more than just a numbers dump. What we're really looking at here is a masterclass in strategy, a company completely transforming itself to fuel its future growth.
Okay, so let's get right into it. First up, the bottom line. And wow, GDS delivered a really clean beat here. GAAP EPS came in at -6 cents when the street was expecting -11 cents. I mean, that's not just a beat, that's smashing expectations. A huge positive surprise for investors right out of the gate, and it really set a bullish tone for the rest of the call. And that strength, it carried right over to the top line. Revenue came in at just about $405 million. That's a 3.5% beat versus what analysts were looking for. And it's also a solid 12.4% jump from last year. So you've got strong execution across the board, top and bottom line. But look, as good as those headline numbers are, they're not the real story here, not even close. The numbers that you really need to pay attention to, the ones that give us clues about the future of this company, they're hidden deep inside the strategy. And believe me, this is where it gets really interesting. And that brings us to the main event, really, the core theme of the whole call, what they're calling the capital light pivot. So what is that? Well, it's this brilliant strategy to turn GDS into a kind of self-funding growth machine. And the way they're doing it is by unlocking the massive value that's been kind of locked away inside their existing data centers. So how are they doing this? The main tool in their toolbox is something called a C-REIT. Now, to put it simply, think of it as a way for GDS to bundle up its mature, stable data centers, the ones with steady cash flow, and sell them off to public investors in China. The CEO himself called this a major breakthrough, and he's right. Why? Because it opens up a whole new faucet of cash for them on really, really good terms. And this just perfectly illustrates the engine they're building. It's this awesome four-step loop. Step 1, they build these huge hyperscale data centers. Step 2, they fill them up with long-term tenants to get those cash flows nice and stable. Step 3, they sell those now mature assets using things as the C-REIT. And then, here's the crucial part, Step 4, they take all that cash and plow it right back into brand new, high-growth projects. It's a cycle that just feeds itself, a totally repeatable, self-funding machine.
Okay, so you might be thinking, does this actually work? Well, here's the proof in the pudding. The C-REIT IPO, it went off at an implied multiple of 16.9 times EV to EBITDA. Now look, that's not just some random number. It is a public, market-stamped benchmark that proves just how valuable GDS's stabilized assets are. And here's the kicker. It's a value that the market has not been giving their own stock credit for. And hey, you don't have to take my word for it. The CFO, Dan Newman, he laid it out plain as day on the call. He pointed out that this multiple is close to double what the market is currently valuing their China business at. So what does that mean? It means every single time they do one of these deals, it creates a ton of value for shareholders, right away. They're basically playing an arbitrage game with their own valuation. It's brilliant. So what's the immediate impact of all this on the company's books? Well, it's huge. Because they're recycling all this capital, GDS was able to slash its full-year CapEx guidance. We're talking a cut of 1.6 billion RMB. That's a massive increase in their financial flexibility. And the best part? It's all funded with their own assets, not by piling on a bunch of new debt. Okay, so let's shift gears a bit, because all of this fancy financial engineering, it's not just for show. It has a very, very specific purpose. GDS is building up its war chest, getting ready to pounce on what they believe is the next huge wave, the absolute explosion in demand for AI infrastructure. Now, management was really clear about this on the call. The AI demand that's coming, it's a completely different animal than what we've seen with the traditional cloud. They're not just talking about more of the same. The huge opportunity they see is in something called AI times inferencing. This stuff is GPU-based. It's super sensitive to any kind of delay, and it needs a ton of power, all located right next to major cities. And this, right here, is GDS's ace in the hole. The company is literally sitting on a 900-megawatt land bank. That's land that's already got power and is ready for development right in those supercritical Tier 1 markets. They are perfectly positioned to hit the ground running the second that large-scale AI demand really takes off. And, this whole AI story isn't just a China thing for them. Their international arm, Day One, is seeing what the CEO called phenomenal growth. Get this, they secured 246 megawatts of new commitments in just the second quarter. That's staggering.
And they're expanding like crazy all over the world, like with a huge new campus in Finland, all to capture that global AI demand. Okay, so the long-term strategy is definitely impressive. But what about right now? Let's take a look at the guidance and see what management is signaling for the road immediately ahead. The most interesting thing about their guidance is actually what didn't change. They kept their full year outlook for both revenue and EBITDA exactly the same. Now you might think, so what? But it's actually a huge deal. Why? Because remember, they're actively selling assets that generate revenue. So for the guidance to stay flat, it means their core underlying business is performing so well that it's making up for everything they're selling off. That's a really strong signal. All right, time to put it all together. This brings us to our final segment, the next call. We're going to take everything we've talked about, the numbers, the strategy, and boil it down into our prediction for next quarter. Give it an equity research style rating, and even float a plausible trade idea. So, after chewing on all the numbers, the strategy, and the tone from management, what's the call? What do we think happens next for GDS? Okay, here's our take. For Q3, don't get spooked if revenue growth looks a little soft. That's just the accounting noise from them selling assets. The numbers you really want to watch are utilization gains and new bookings. As for the stock price, we're thinking it probably consolidates a bit in the short term, but as the market really starts to get this valuation arbitrage they've proven with the C-REIT, we expect to see some real positive momentum. So our core thesis is pretty simple. GDS is turning into a self-funding growth machine, and it's proving its parts are worth way more than its stock price. For that reason, our rating is a solid outperform. And a potential trade idea? You could think about a pairs trade. Go long GDS and short a basket of their competitors who aren't as capital efficient. The bet is that as GDS keeps executing, that valuation gap is going to close, and it'll outperform the rest of the sector. And as always, just a quick and important reminder, this is for informational purposes only. It is not financial advice.